Good morning, everyone, and thank you very much for joining us bright and early for this panel on crypto markets, on where demand is coming from and how that might evolve going forward. I'm joined by leaders from two institutions who represent the two main pools of demand, retail and institutional. And while at the surface they may seem like they are worlds apart, they actually have a lot more in common than we realize. I'm joined by Steve Quirk, Executive Vice President of Trading Education at TD Ameritrade, and by Thomas Chippis, the CEO of crypto exchange ErisX. Welcome, both of you, and thank you so much for being here.
Good morning.
Now, before we dive in, I'd like us to warm up with a round of personal confessions. It's going to help us bond, and if you like, I'll go first. I have not yet checked the Bitcoin price this morning.
It reached a high at 4 a.m. I didn't check it either, he told me.
Tom, your turn. Confession. Have you?
Well, I told him. I was at 83.50, I think, at 4 o'clock Eastern this morning.
Really? Okay.
And he was up at 4 a.m., so.
So we won't even go into why. But it would be actually really quite boring, I think, to work in a sector where you understood everything.
Were you head to what?
Where you understood everything?
Yes.
Yeah. Anyway, diving into things that we do understand. Steve, every retail investor in the US knows the name TD Ameritrade, and you're one of the first institutions to offer access to Bitcoin futures to your retail clients. What sort of interest in cryptocurrencies are you seeing?
Well, we launched the Bitcoin future in December of 17. And obviously, I think everybody in here understands what the price was when we launched it. But so there was tremendous interest. But what's happened over the course of the year and a half since we launched that is the interest, while the price has obviously come down quite a bit, although in the last couple of days, as Tom just said, nice rebound. Compare that to the Ubers or the rest of the market and looks pretty healthy.
Little bit.
Yeah, exactly. But the interest is it's not waned. And what I mean by that is there's a variety of ways we can see that. Number one, people just inquiring about when are we going to provide them with access to more products.
So actually inbound requests for this?
Inbound, both we get calls, we get emails. We've had 60,000 clients trade something in this complex. And then we're also the largest investor educator in the US. So if we do a session or create online education that's around digital assets or do something in person, the attendance and the viewership is off the charts. And it's just, it's really fascinating to watch.
Who is watching? Do you have a typical profile?
You know, that's actually the thing that was probably the most interesting when we started watching and observing who is doing both, who's observing this education, who's digesting the content, but also who's trading in this complex. Because the thought is it's much like many of the people in the room, younger people. But when we looked at it, 60% of them are, we call it, we have a segmentation that's called empowered. 45 and older, 250,000 investable assets. 60% of the trading is happening there.
So
and by the way,
they're the millennials that we hear.
They're the ones that are expressing the most interest. They just want some exposure to this asset class because they think it's the future.
What are they more interested in? Is it the underlying story that they care about, or do they see the potential for profits?
Both. I would say both. And it's very fascinating because everybody would perceive that that's not who is the primary client that's interested in this. It's kind of like, I was joking with these guys last night, it's kind of like discovering that your parents are watching Game of Thrones upstairs and you didn't even realize it. You're watching it downstairs and you realize, oh my God, they're watching it upstairs as well.
And then the embarrassment of having cool parents.
Exactly.
Tom, you're coming at this market from a different tangent. You're focusing on institutional investors, which is curious because crypto is one of the only asset currently traded that started out retail. It's a retail asset. So why institutions?
Well, I'd say we're focusing on intermediaries, and certainly Steve represents with TD Ameritrade a retail intermediary, but there's different types of intermediaries. So we believe that there's different market structures that can be successful. To date, it has been, as you said, mostly retail driven. People opening up accounts on platforms that maybe started off only offering access to, say, Bitcoin and added additional coins and maybe built other services around that, but they're not full service providers. So Our thesis is that in order to build a robust marketplace, we need different types of participants that are in the market for different reasons. So Steve gave you some information about the folks at TD Ameritrade that are trading the products. There's definitely institutional interest on the long side getting into this market, saying that if you look at the performance of Bitcoin as a store of value, you look at the opportunity for platforms that will be powered by things like Ethereum, they want to get into that now and get into it early, and they're not looking to necessarily churn based upon price. That being said, you need speculators as well who are willing to take short-term price movement as an opportunity to trade in order to flesh that market out. Bound that with people like miners and what have you, which we're lucky enough to have as investors and people we're working with. We start to build a real robust commodities market with spot and then futures. And you start to see that there's different types of people that want to participate. They work through different types of intermediaries to get to the market, and you have to have a platform that's suitable for all.
And when it comes down to platforms suitable for all, how would that work? We have two tiers now. We have the institutional demand, the retail demand. How are the requirements different?
Well, I think today, across any asset class, I don't know if I would say that institutions are exclusively one type of investor and retail are another. If you look at the US equity markets today, the majority of that is accessed through an intermediary of one kind. Whether you're trading through TD Ameritrade, you're buying a mutual fund at Vanguard, you're purchasing an ETF listed by State Street, whatever it might be, retail money generally is directed through an institutional intermediary of one kind who services retail. So from our perspective, that particular sector has a set of needs of how a market should operate, everything from the risk procedures, security procedures, surveillance, and things of this nature. And then you have those who service institutions. So you're sort of broker-dealers, prime brokers, what have you, that service other institutions that have a different set of needs altogether. So we don't view retail as this exclusive thing. You must be a two-legged person who whips out their phone and takes a picture of their credit card and sends it somewhere and crosses their fingers. You go through an intermediary that you trust. And most people today that are investing in the markets are investing in the markets through a platform. So they're allocating to equities, allocating to fixed income. They have different types of accounts, brokerage, IRA, 529 here in the US, these sorts of things. So from our perspective, by enabling access to spot crypto and futures, that's another tool that those registered investment advisors or individual investors can deploy on those platforms on behalf of the retail customer.
Yeah, and maybe this will help. Our business consists, we have 11 million clients, but half of our business, or roughly 2/3, is what I'd call pure retail clients.
What does that mean?
Pure retail means mom and pop investors, all walks of life from, very young to, all the way across the whole gamut. We also have 7,000 RIAs, registered investment advisors,
They channel the retail.
They would have 1,000 accounts for 1,000 retail clients. They have as much interest as a retail client does because they want exposure for all these clients that they have. They're all truly pure retail, but you sort of have a quasi-institutional aspect and the interest is just as strong on the institutional side, or what we call the institutional side.
I guess the layers as well. And if an institution or an RIA, for instance, has to answer to retail clients, then in a way, do you see them having even more of an obligation, shall we say, to get informed, to get educated, because their clients will be asking?
Well, that's why we provide them the education, because, our RIAs would also use options and things, other asset classes or derivatives, and think of trying to educate 1,000 people on an option and why it's a good idea to write a covered call on something, as opposed to just having content that's available that you can just dispense to them, and that way they feel comfortable with it and give you the authority to use that. That's exactly what we do.
You also, you are known for your retail, breadth and reach, but you at the same time are also a shareholder in ErisX, an institutional exchange.
Yep.
Can you talk to us about bridging that gap?
Sure. If you think about what a retail client wants, they're very comfortable and familiar with the model that exists today. The model that exists today is, I want to invest or trade in all these things in one place with a trusted entity. I want to have the same experience that I have in an equity market, in an option market, on the fixed income market. I want to have that same experience, and that's actually what we're working on with Eris and trying to achieve. Because now I can say, we also have currency trading that's available at TD Ameritrade. Not a huge percent of people want to do it, but the experience is very similar to what it would be if I was purchasing an equity or doing anything else. Maybe they want to hedge some overseas risk that they have, with exposure to foreign markets. We're just trying to give them the same experience, and it's very important to them that they have an experience that looks like the experience they're comfortable with.
Yeah, the grown-up experience. I think Tom alluded to this just a minute ago, how institutions, I'm often accused of being pedantic about my words. I mean, institutions is such a broad thing, we should define that better, but a lot of them, as you pointed out, depend on retail clients. They're influenced by retail demand. Steve, to what extent do you think institutions influence retail demand the other way?
Go ahead.
I'd say it's a two-way street depending upon the product you're talking about. Without a doubt, investment in cryptocurrencies, digital assets generally, has been driven by the retail market. And we have this very interesting dynamic today where you have the market centers, exchanges, and utilities that exist in sort of the North American and European sphere. And then we have the lightly regulated, different oriented venues that exist, generally servicing clients in Asia or clients in other parts of the world that want to participate in that type of market. So without a doubt, just like any new innovative technology or what have you, some of these things start from a retail or individual interest, but then build up because the means of access in financial products, of course, certainty of clearing and settlement, safety and soundness, these sorts of things start to take hold. And in order to enact mass adoption, you need to provide those things. And the best way to provide those things is at scale with a marketplace and a platform that takes those things to heart, as opposed to things that are built up from a grassroots perspective that certainly can scale over time. But I think we've seen a lot of conflict in the marketplace today where things that are generally accepted with markets professionals about how trades settle, how trades clear, how you protect assets, how you perform KYC, AML, et cetera, seem to be eschewed by those that are more interested in the tech innovation side of things. So as an industry, I think we're still finding that balance. And what's fantastic for the individual investor, especially today, is they have choice. So they can decide how important that is to them. But for those that want ease of access, simplicity, and those that want the protective nature of what they're used to, and as Steve was alluding to with things like equities, those platforms are here as well, and they can take advantage of them today.
And I imagine for retail investors, seeing the institutions roll out various services like this adds to the reliability, I guess, of the whole sector and the confidence.
Definitely confidence. I mean, reliability is proven in the marketplace, of course, but certainly confidence. One of the largest global market makers, Virtu, released their earnings a few weeks back, and their CEO, Doug Sifu, was asked about crypto. And the first comment he made was that anything they trade, so he didn't even say in crypto, he said anything we trade, we have to have certainty of clearance and settlement. That's how we can provide the liquidity across all these asset classes because we know how the marketplace functions and how clearing and settlement works. So certainty that the trade I've executed is actually done and I have that position on or off my books. Second thing he said is they're an investor in ErisX, which is great, but the whole concept of clearance and settlement certainty is exceedingly important. And having run a large global trading business in my career, I can tell you that you manage risk by knowing what's actually happened, and having certainty and finality is the key element of knowing what's happened, so then you can see what's on your book and you can take appropriate action when that next tick comes in and you decide what to do with your book.
That vote of confidence.
And he brought up Virtu, perfect example of an experience that so they already make markets for TD Ameritrade clients in equities and many other asset classes. So they understand what a retail client is looking for in a marketplace. That's critical. Like, you can't start with people that don't have an understanding of what a retail client is looking for, because again, I told you about the demand. As soon as you open the door, you're going to have a lot of people, and it better be a good experience because you really get one shot. You can't have a poor experience when you're putting something in front of a large number of clients.
And especially given the headlines that we see with unfortunate frequency in the crypto world about hacks, about dubious practices, etc. Do you see that influencing your clients at all?
I think the clients that are interested in it see through that. I mean, they understand that it's, as Tom pointed out, this is new. I mean, I shouldn't say it's new. It's not new, but it's newish to retail clients. So I think that they understand it. That's why they want to go to a trusted partner, though. That's why they look. we're bright enough to realize that there's probably a decent number of our clients that are somewhere else because we don't give them the capability to do what they want to do. All we want to do is bring them back, and we would be very successful, but I'm sure we'll attract others as well.
And that's fascinating. It's becoming increasingly obvious that we have the institutions influencing retail, retail influencing institutions. There's less of a divide than we have most of us been led to believe up until now. Tom, we have been hearing for a few years now about this wall of institutional money that is poised to come in the market and push up prices. Do you think that maybe is part of what's happening now, or we know that many of them a few of them have dipped their sizable toes into this relatively small market, but on the whole, they seem to be waiting. What's your take on what the institutions broadly, to generalize, are thinking?
Yeah, I think if I knew that I'd still be at home looking at the price chart. Two things come to mind. I mean, the first is that institutions already are here. I'm not quite sure what the crypto Twitter sphere is looking for as a positive indication that it's actually here.
A wall.
But it's here. Is it a wall, a speed bump? I'm not quite sure. But it's here. I certainly know institutions that are managing substantial sums in the marketplace today. You look at even in the public domain, Grayscale, sent out a pretty large advertising campaign, Drop Gold, and they've been out there talking about the size of their fund, and that's been there for quite some time as well. But that's one of many. So these products are accessible today. I don't know if wall of institutional money means it makes the Kiplinger's top 20, low-cost mutual funds. I'm not quite sure, and I'm not the arbiter of what means institutional is here or not. What I will say is, relative to other assets, crypto is still relatively small. So in order to produce gains and opportunity on a risk-adjusted basis for an institution who may already be managing billions of dollars of assets, you'd have to get really, really big in crypto really, really fast. And when you adjust for volatility, it starts to trim what your desire might be to really deploy a substantial amount of capital into it. So it is happening. I'm not the one to apologize, but I'll say in general to the world, apologies is not happening fast enough. But it's definitely happened. It continues to happen. But I think you have to stack that up against all the other opportunities. I mean, I joke on a weekend, if I'm having dinner with friends that talk about something other than crypto, there's other things going on in the world, They still print books. So, I think it's happening. It's never going to be fast enough for people that are writing tweets and headlines, but without a doubt, there are people in this room today managing, very substantial 9-figure sums in this space. It's just actually small compared to the size of, say, the US or Japanese equity market. So it's very, very difficult to take a substantive position that'll produce outsized gains on a risk-adjusted basis when you're managing that large a sum of money.
In the institution that you talk to, do they mention if they're waiting for something specific, such as more liquidity or maybe an ETF or something like that? Do they say anything about that?
Not generally. I think access as a general conversation does take place today because, as I sort of colloquially suggested, some folks don't want to whip out their smartphone and take a picture of their credit card and ID and open an account. I think it's more along the lines of what Steve implied, which is full service providers want to add this as a potential opportunity for trading or investing on their platforms. So it's more of that type of access, which is certainly we're focused on providing our part of that as an exchange and clearinghouse, such that those intermediaries can continue to integrate these into their broader platforms. As far as things like getting an approved ETF and things of that nature, that's going to come. I think certainty of price is very important, and we'd like to think that ErisX is contributing to that. Our spot market is live. That is a physically delivered product. It's an actual spot price. It's not an interpreted, derived, or interpolated price based upon a basket of other things at a point in time. Those cash settle products also have a role to play, but probably one of the most challenging things today is getting regulators comfortable that the price being used to price these other instruments is accurate and comes from an exchange they can trust. And certainly, I'm sure everyone in this room has either read or claims to have read the Bitwise report. And I think that was an excellent breakdown of a simple view of, is this volume real? And it's simple, but it's a very difficult thing to discern. And I think they did a great job doing it. So that's just an example of things that are happening to educate regulators as to why having good prices will lead to the development of these other derivative products.
Now, educating the regulators and the market as well. Tom, do you get the sense that the retail market in general is waiting for an ETF?
I think we hear that quite a bit. Just to add on for a minute to one of Tom's point, part of what we do is try and help clients understand. So in other words, we're an agent. We don't tell people what to do. We just give them the vehicle, the education, the content, the research, and the products that they request and that they show an interest in. But you also have to dispel some myths occasionally. And so, one of the myths is, oh my God, Bitcoin, so volatile, all the cryptos are so volatile. The number one traded stock at TD Ameritrade is Amazon. Last quarter, it was more volatile than
Really?
Bitcoin. Yes.
And people don't know this, do they?
They don't know that. No. You point those things out just so that people understand, like the volatility, you can it's a myth, but you can embrace it. There are a lot of people who love volatility in their products, and that's what they're looking for. There are a lot of people that say, I would like something with low volatility, a low beta stock or whatever asset class that's not going to move a lot. And
Bitcoin.
Yeah, there's, well, not lately, not the last couple days, but.
Yeah. Tom, you mentioned that you launched your spot exchange recently, and also pending the relevant authorizations, you will be launching physically delivered futures at some point. Why physically delivered?
Yeah, so there's two licenses you need to operate an exchange and a clearinghouse. We have one of them, the DCM, which is an exchange license, DCO for clearinghouse, and that's the one I think you're referring to that we're in process on. Why physically delivered? I mean, today, if you're looking at commodities markets generally, what you're trying to do with futures is, other than potentially speculate, is you're trying to hedge risk, and they're risk management tools. And those risk management tools function better when the basis is the actual underlying commodity. So by having a physically delivered futures product running in a platform with the physically delivered spot product, you bring together a marketplace where commodity producers, hedgers, investors, speculators, market makers can all interact, producing an opportunity for greater liquidity to be there for those that want to utilize the futures to hedge their risk. So as soon as you move to a derived product, and I'm not implying that derived products are per se bad, they just serve a different purpose. There's a gap in the market today, and having real-time physically delivered futures where you can open and close the position and get the use of that collateral instantaneously is going to be a tool that will aid in the growth of this marketplace. We certainly provided commentary in this regard in the CFTC's Ethereum RFI. We provided a lot of backup for that as how we saw parallels to everything from gold markets to jet fuel and things like that, very, very similarly. So these are commodities. We should have the tools that are proven over time to work well to manage risk in commodities markets.
Steve, your clients have been trading Bitcoin futures for some time, but the cash-settled variety.
Yep.
Do you see demand amongst the retail market for the physically settled?
Yes, because so our futures trading would make up about anywhere from 10 to 12% of our, let's call it 1 million trades a day. They're very familiar with physically settled. So the requests that we get, JB right here and Sinena back there from the digital asset team, the requests that we get are two. Number one, I'd like this to be physically settled the same way that the other futures products are. And they would like to see these futures. There's another one they'd like to see, which we're probably not going to launch. That would be a cannabis physically delivered future.
Why can't you launch that?
I don't know that we would be permitted to launch that.
Everything changes, right? Do you see demand coming more for derivatives from the retail market or for spot? Where's the growth going to come?
I actually would say probably if I had to gauge it, it'd probably be bigger demand on the spot side, but I wouldn't skew it by much. Probably 60. I'm making this up. 60-40.
Tom, what are you seeing? Where do you think the growth of demand is going to come from? Mainly from institutions, derivatives or spot?
Well, I think for institutions, you might see greater use of derivatives simply because they tend to be managing portfolio and risk and exposure at points in time, and a series of futures gives them the tools they need to actually do that. That being said, they may have a long-term view where they want to take a position in spot and write futures around it as well, too. So a lot of it will depend on their underlying product and what they're trying to deliver. So if you're building an ETF or something built upon spot or built upon futures, you're going to have a need that varies. I'd also point out that we're very fortunate to be working with a number of miners as well too, who are delivering the commodity as well. And if you're a producer of a commodity, you're going to be, I think you're an institution, you're just a different type of institution. You're going to be utilizing those futures to hedge your risk and your output over time as you have a view on your productivity cost versus the potential realized value of the asset at some future point in time.
They're actually a complement to each other. Because, well, if you think about like today in the world of TD Ameritrade, about 65% of our trades are equity trades, 35% are derivatives. They complement each other, and that's the way people use them. You know, they want a portfolio that, you know, there might be hedges, there might be things that generate income, and once you introduce derivatives there, you have the ability to do that, and they understand that. So you don't have to re-educate them on those products. It's just a different asset class with the same identical strategies. So when we've done that, you know, from equity options to futures options to, you know, to a variety of different products.
With fairly sophisticated trading strategies, I imagine. And would that lead to the development of different types of products that you might think of offering?
I'll leave that to you.
I mean, potentially. I think, you know, sky's the limit, of course, but we're going to stick to the basics for now. There's a lot of pick and shovel work that needs to be done in order to open this up for the wider adoption we've been talking about. But certainly, once you have a liquid, fully functioning market in spot and derivatives, there's no lack of innovation that could take place. I think we want to do that in not only a prudent and responsible way, but in a way that's actually building things people want. It's very easy to close the door and take out the pen and draw on the whiteboard. It doesn't mean anyone's going to care about the picture when you're done. So we want to get feedback from people before we engage in the hubris that we know the right answer without asking.
Yeah, and as we have seen, products that don't get the liquidity don't tend to survive very long. Steve, where do you see demand growth coming more from the retail side or the institutional side going forward, time frame 5-10 years?
I think we'll see the initial demand from the retail side. It's just a little stronger. That's just if we look at things from an experience standpoint. What I'll call institutional, our RAs are a little, you know, they're a little slower to adapt a new asset class. But I would also point out we have businesses in Asia. So we are licensed in Hong Kong and in Singapore.
And what are you seeing there?
Well, tremendous demand.
On the retail side?
Yeah, on the retail side. Yep. Mm-hmm. And they're very active. And I'll tell you a very funny story. We went over to launch our entity in Hong Kong a couple of years ago, and we went and met with the regulator right before we were going to launch, and it was right around the time we were launching Bitcoin futures, and we made it clear to them we weren't starting off. We weren't coming there just to launch Bitcoin futures and blah blah blah. And our CEO, you know, does a press conference, and there's all kinds of people in the room. That's the only thing they asked him about. Every single newspaper article wrote about TD Ameritrade's coming over to launch Bitcoin futures, and we're like, we better call that regulator back and tell them, look, we didn't mean to do this. We tried to talk about anything else. That's all they would ask us.
What are you going to do? Not answer the questions?
Yeah, they were very cool and understanding, but you know, tremendous demand over there.
And do you see more demand for derivatives or spot?
Probably both. I would say both.
So interesting. Now, Tom, what do you think has changed most in the market over the past 12 months?
Well, I'd say in the last 12 months, as we were all shoveling through crypto winter, I'd say that a lot of good work has been done. So some bad ideas have, you know, like orphaned Ben and Jerry's flavors that go to the graveyard up there in Vermont. They just, you know, some bad ideas went away and never come back again, and we can look at them and laugh about them. So I think the last 12 months have been very positive for just getting the hard work done that needs to be done. I'd say in addition, regulators have done an excellent job of digging in and getting educated. I know it's very popular in these forums to have negative views or comments about that. I think we have had a lot of regulatory participation at the conference yesterday, and I know there's more to come, which is fantastic. But I would say they've rolled up their sleeves and become educated, and they're far more educated, at least in the US, than I think most people give them credit for. So if the output of the last 12 months has been building good foundational tools and utilities and and operating businesses and regulators to become more informed. Those two things together are leading to a good outcome for everybody.
Steve, if we have another bull run, how will this one be different, do you think?
I read this great analogy. I like this analogy that somebody wrote about digital assets, and they basically did a comparison of the tech bubble and said, at that point in time, a .com, put a .com on anything and watch the stock go crazy. And so there was, obviously we all know what happened in 2000, that burst, and then out of that came the FANG complex. And the FANG complex would be, if you looked at the top 20 stocks traded by TD Ameritrade clients, there's probably 5 of them that are in there every single day. And so the analogy this gentleman was making was the second iteration of this could look just like the FANG complex, which I thought was quite interesting.
Yeah, that is, and hopefully we'll be seeing maybe some evolution of that theory soon, who knows. I'd like to thank you both so much for being up here with me today. I personally have enjoyed it very much. I've learned a lot, and I hope you all have enjoyed it too. Thank you very much for joining us. Thanks. No. Thanks. Thanks, Noel.
Before I introduce the next panel, I just wanted to take a moment to say thanks again to the sponsors for this event. We have some amazing sponsors this year, and in particular, I wanted to thank our Block 5 sponsors, and these include Block, Deloitte, eToro, Flexa, IBM, and Tata Consulting Services. And also a special shout out to Ledger, who has been a supporter of this conference for all 5 years that it has run. So we couldn't actually do this conference without you. Huge thank you. And I do want to mention that this is the hub of Blockchain Week. So Consensus is the main event, but there are so many events going on this week.